real estate junkie. I just love real estate. We're now going through this very painful time in the market where a lot of these single syndications are losing everything, losing all their money, all their investors' capital. There's just a lot of pain going on.
You're going to have hardships. You're going to have headwinds. And so you better have a structure that can support you.
Listening to the herd mentality, and I was like, yeah, take out 10% of my paycheck and just put it over into this 401k thing.
Yep.
But then I started doing the back of the napkin math. I was like, but it's only really growing about what I'm contributing into it. It's not really growing that fast.
In real estate, it's always our winning investments that dominate the headlines. But there's rarely straight talk about the moment we realized our investments just weren't going according to plan. On this show, we sit down with operators, lenders, investors, and brokers, and we break down what really happened. Hard lessons most people would rather keep private. Welcome to the show.
So here we are again, my friend.
Again, one more time. People are going to start getting irritated.
No, they're not. No, they're not. But it was funny because we had to come on, at least turn the cameras on. We were talking this morning about how you don't have any investments in the stock market. And I thought, people are going to want to know why and how you got to that point. So are you down to talk about that?
Yeah. I think a lot of our investors can relate.
Yeah.
Again, I guess I'm a recovering stock market addict or something like that.
Myself included.
Yeah, I've totally exited the market. Actually, I exited the stock market, back in my mid-20s.
Okay.
Early on, it's kind of, hopefully a story that everybody can relate to really is that, you get your first job out of college and you start making a little bit extra money and people are saying, hey, this 401k thing, you got to save for your retirement. So being a diligent, person,
yep.
And
smart young man.
Yeah, smart young man, and listening to the herd mentality. And I was like, yeah, take out 10% of my paycheck and just put it over into this 401k thing.
Yep.
And magically, hopefully that'll help me retire one day. Until I started to realize, as I was looking at the statements, I was like, my 401k is getting, it's growing. But then I started doing the back of the napkin math. I was like, but it's only really growing about what I'm contributing into it. It's not really growing that fast. My fish pond number 2 is not,
that's right.
Is not growing very quickly here. And then I started to realize that if it was growing at this rate, it was not going to get me to where I wanted to go. I mean, this will be a whole nother podcast, but
sure.
At the time, I'm 22 to 25 years old thinking, I want to retire. I want to retire at 50. I'm going to be out.
Yeah.
I'm done with this. And this retirement plan is not going to get me there.
Yeah.
So I sit down with my advisor, like everybody does, and he tries to explain to me what I'm in, and it's like, yeah, we've got this real estate stock or mutual fund, and then we've got this U.S. growth fund, U.S. company growth fund. We've got some bond funds over here, and everything was funds, right?
Clear as mud.
Yeah, 100%, 100%. Just mass confusion,
sure.
Right? And then, of course, whenever you wanted to talk to them about fees, well, yeah, no, we have our fee, but then, it was just a convoluted mess. Right. And I think people out there totally relate to this. This is why we've had investors over the past decade come invest with us in the private markets and start exiting the public markets, because I think people feel the same confusion, and we're sold the same bill of goods that just your 401k, your retirement account will lead you to financial retirement in the future.
Yeah.
And then I think that a lot of people realize the same thing that I did early on was that no, this slow growth thing just does not work.
Yeah. You're trying to keep up with inflation at the same time and all the rest of it.
Yeah. And then you start breaking it down. You start to, like we were saying before, you start digging around in the weeds and you start realizing that your financial advisor's company is taking their cut. Then you start realizing that every mutual fund they put you into is also charging some sort of fee. And then when you really start breaking it down, then it's like, okay, then the company you've invested in is also charging you too. So no wonder your money is not growing that fast because it's being diluted
right
through these fund structures.
Yeah, we've talked about that long and windy road of money in past conversations, right?
Yeah.
So you got your stock, you realized this. What'd you do next? You put it into an IRA? Did you put it into,
I did.
Where'd you put the money? Yeah,
I did. Yeah. So I went all in. So for those of you guys that don't know, I'm a real estate junkie. I just love real estate, born into it, basically, and been doing it most of my life. And so I just went all in, on real estate. So at that time, I found a great self-directed IRA company in which I rolled it over to. We work with a great one now, Equity Trust. But that company allowed me to roll my 401k over to invest in whatever I wanted to. And at the time, I bought a condo, rented it out, had it, had a property management company that managed it. That condo grew over time, appreciation, had my renters paying down the mortgage. And, we just went from there. And so I built that retirement package up a lot faster and a lot better than I could have, going the public equity route of investing in mutual funds.
Sure. So what was your next step? So you found the benefit of that investment via your self-directed IRA.
Yeah.
At some point, you're moving in a bigger and better direction. How'd you get there?
Well, yeah. So, because the evolution, right, of investing in real estate, and we've talked about this a little bit before, but as that portfolio started growing, I started growing more and more in real estate, right? Then we found syndications and we found larger properties. So we wanted to move up into buying apartment complexes and larger rental generation, generating assets, right? And we found syndications, and you found a lot of people that were liked the idea of a syndication model because they were able to take their capital and invest it directly into real estate, cash producing real estate, and take out all the middlemen, right?
Yeah.
You don't have to invest in, say, a REIT or whatever else, or something that's publicly traded. You can cut out all the middlemen, go straight to the guys that are doing the work, and generate, an outsized return, something that you couldn't get, in the stock market.
Yeah. So talk to me, switching gears just a little bit, when we make the comparison between some of those funds that you were talking about that you can get into in the stock market and what we're doing. There are some similarities in the way that we're structuring Two Waters Capital. Talk about the similarities and what makes it a little bit different and more beneficial to the investor.
Yeah. So it's funny because we get this pushback all the time. It's like, Brian, you got out of funds. You're even saying yourself right here, you got out of the fund model. Like that's, that a lot of our investors done the same thing. They've exited. They don't like mutual funds. It's like, that's like a 4-letter word to some of our investors. They're like, oh, we don't funds. Brian, why are you stepping away from single syndication and investing more like $1 trillion funds?
That's right.
And it's just a maturation, and it's gone full circle for me. Because when we had this, we're now going through this very painful time in the market where a lot of these single syndications are losing everything, losing all their money, all their investors' capital. Sometimes the operator themselves is having to turn in the keys to the bank. There's just a lot of pain going on. And so we really, in this company, really scrutinized, okay, structurally, what was putting us at risk if we use single syndications moving forward? And why do some of these largest REITs and these $1 trillion, funds like Blackstone, why are they using these funds methods? At first I always like to say, well, they're just these Harvard types that are just, they all think they're smarter than everybody else. But unfortunately they kind of are smarter than everybody else. So you look at it like, okay, what are the smartest people, the people that are investing the most money? Blackstone, I don't know if you know this, has done the biggest transaction, actually private transaction, for their institutional investors in the history of private equity. It was when they bought Hilton back in the, late
07 or
something like that.
Somewhere in
the So, I don't think a lot of people know that, but again, it's funny for the listeners that maybe haven't invested in a private real estate fund or a private syndication. We've talked about this a little bit. They're probably already invested in one of these through a Blackstone or $1 trillion, these huge, massive investment companies, investment banks, private investment companies. Yeah. So I digress a little bit, but so you look back, it was part of that study, it's a part of that reflection, that lessons, these hard lessons we're learning through going through all this pain when we were syndicating these deals and seeing all these syndications really fail. And to me, it made sense after researching how these $1 trillion companies set up their funds to protect this from happening to their investors, right? Yeah. So their institutional investors are protected, their downsides are protected. So even though I'm not saying that these companies haven't lost money, because they are in a lot of deals, and you've heard of, you can hear, we're in the industry, so we hear of a lot of these deals that, hey, that one didn't work out, but it didn't tank their investor completely. Yeah. Just that single property, hey, they had to turn in this office building, this downtown San Francisco office building, and they lost money on that particular building. Yeah. But that fund itself typically does not go under, and typically that fund does not lose all of its investors' capital. Right? Yeah.
Yeah. I was, it's funny you brought up Blackstone, because we were just listening to the CEO tell stories about his history and some of those references to those buildings he bought that maybe were at a loss, and in comparison to the Hilton, which was a huge win. Yeah. But also sharing that he was conveying that it was less about the asset and more about the structure, because, and I think that's that Harvard philosophy I think that you're alluding to, where as you grow up in single syndications and you see every deal and you feel really confident that you're a great investor by analyzing every deal, what the CEO of Blackstone is saying is that's wonderful, and you're going to have hardships, you're going to have headwinds, and so you better have a structure that can support you.
Oh, we've seen it. I mean, the market is proving it out. There's no doubt. Yeah. Right. The market's proving it out. If you're stuck in a single syndication, if you have, like myself, I'm stuck in a bunch of single syndications. We've talked about this before. I've got 20 limited partner deals, and I'm stuck in them. We're just at the mercy of, how the market moves now. Yeah. There's nothing that a lot of these single syndications that I got myself into as a limited partner, there's not much we can do. I mean, we should probably do another podcast on that. Like, yeah, helping people out.
Hearing you say that, sorry, go ahead.
But structurally, you're 100%. I'm getting off topic a little bit, but 100%. This is the exact reason why we're learning. We learned the hard lesson of like, man, this really exposes this investment vehicle, right? The single syndication. It traps your money into one deal, and if that deal happens to go bad, kapoof, you lose everything. Where the $1 trillion investors, the people that are moving the most money for the most institutions, are protecting their downside by creating funds. Yeah. Bottom line.
One of the interesting points I found from that conversation with the Blackstone CEO that we were listening to also was he was talking about the importance of neighborhoods.
Yeah.
You have a perspective on that?
100%. Yeah. I think that's where we got overexposed to.
And define maybe what neighborhoods means to you.
Well, I think neighborhoods means, you want to invest in places that are neighborhoods or communities that are gaining investment, not just from you, but from the community. A neighborhood really is a collection of people, right? And so you got to seek those neighborhoods, those collections of people that are growing, right? You don't go to those neighborhoods where those collections of people are leaving, or that area is dying. So that's another one of our lessons learned as well, and one of our core strategies as well is to invest in better areas, higher quality assets, along with putting all those high quality assets into a fund. And I heard this quote, I'm going to steal this phrase, but I just loved it, was that we've really changed from a philosophy of we're buying apartments and then finding investors for it, to we're really partnering with investors, creating our own neighborhood of investors and investing in apartment complex on their behalf. Right. There's a nuance to that, right? We're not just going out there and being like, oh, okay, we're finding a deal, and then we try to, market it as such, as that's how we used to try to attract investors in. What we're really trying to do is create a community, a neighborhood within our own company that are like-minded investors that believe in our strategy, believe in the downside protection that we're trying to get them, and the diversification we're trying to get them, and take that neighborhood's money and invest it on their behalf.
Right.
So I don't know if that makes sense, but I did.
Absolutely. Well, we've gone all over the place. We started with why the heck are you out of the stock market? And we got into why $1 trillion investments are made the way they're made. And if you could leave the listeners with a take-home message to wrap this all up, what would that be?
I just, if you, in life, you can't continue to do the same thing over and over again. Right.
Yeah.
And expect a different result. I think that's the coined insanity phrase.
Sure.
Right. So in every down moment, if you are in some of these bad syndications, or if you are in, you've taken some losses in your investment portfolio, just take a hard look at it and see what can you do to improve it. Whether that's, you're taking some losses in the stock market or some mutual funds that you're doing, or you're taking some losses in the real estate that you own. It doesn't matter. It takes the time to evaluate it and reassess. I think when I started to reassess, you start to see and look for people that are smart investors, and you start wanting to mirror and learn from those smart investors. So that would, I think, the take home would be, that's the lesson learned, is just kind of find some of these smarter investors and really learn what they're doing. Try to mirror.
Don't recreate the wheel.
Yeah. Sometimes you don't have to.
Yeah.
Sometimes you don't have to, right? I mean, there's success breeds success sometimes, and so seeing successful people and kind of following that success. But as they say, you learn more from the falls than you do from other people's successes. So it's really interesting. And I think that's why this podcast is really interesting, is what we want to really do is learn the bigger lessons from some of the failures or the cracks in the markets, or and what do you do when that happens, and how do you adjust, and how do you move forward so that it doesn't happen again?
That's right. It's mindset, skill set, and execution. Another great time with you, my man.
Hey, appreciate it.
Awesome.